All right, everyone, buckle up. We're about to go deep on something that's, well, it's been rattling some cages on Wall Street. We're going to break down a meme stock, AMC to be exact. But this isn't just about the ticker, it's about the mindset, the mission. Let's get to it. Everything really kicks off with this idea, this headline that sounds totally backwards, but, it makes sense to us. It's smart to be dumb money. This is the core belief we're going to unpack today. The idea that the old playbook is out the window and that the play nobody sees coming is maybe the smartest one of all. Okay, before we launch, we got to do the pre-flight check. Just so we're all clear, this is just for information. It's not financial advice. And for full transparency, this entire breakdown was put together with some help from AI, specifically Google's Notebook LM, using data from places like Chart Exchange, FinViz, and Ape Wisdom. All right, systems are go. Now look, if you came here for a boring old lecture on PE ratios and discounting cash flow, you're in for a surprise. We're going off the grid here. This isn't about what some textbook says. It's about a community, a belief, and a battle of ideas that plays out in real time every single day. So here's the plan. We're going to look at AMC from two totally different angles. First, we'll dive into the retail investor's playbook, what we call the Ape Thesis. Then, we'll flip the script and look at it through the eyes of Wall Street. It's like two different species looking at the same object and seeing completely different things. So let's start with us, the apes. Why are so many people holding onto this stock for dear life? I'll give you a hint. It's got nothing to do with popcorn sales. It's about a particular setup in the market. And to get it, you first have to understand who we're up against. And that brings us to the short sellers. It's pretty simple, really. They're betting the stock is going to go down. They borrow shares, sell them, and plan to buy them back later when they're cheaper. But here's the key, the part you can't forget. To close out their bet, they have to buy the shares back, period. Which brings us to this little number. This is maybe the most important piece of data in the whole ape universe, 9.65%. According to FinViz, that's how much of AMC's tradable stock is being shorted. Now, to a normal investor, that might look like a huge warning sign. To an ape, well, that's the whole point. So here's how it all comes together. A big short float means a lot of people are betting on failure. We see that as fuel. It's the setup for a short squeeze. See, if we can buy and hold and push the price up, the short sellers start bleeding money. Eventually, they have to give up and buy back their shares to stop the losses. And what happens when they buy? It just pushes the price higher. It's a beautiful, vicious cycle. It's a test of wills. Okay, let's hop over to the other side of this thing. Let's see what it looks like from the top of their ivory tower. For a traditional Wall Street analyst, all that stuff we just talked about, it might as well be science fiction. They look at one thing, the company's books. And when they open up the books on AMC, this is what they see, a big, fat dash. That's the price-to-earnings ratio. A dash basically means there are no earnings. The company isn't profitable. For a guy who lives and breathes fundamentals, that's pretty much game over. And yeah, the rest of the report card isn't exactly glowing from their point of view. Earnings per share, negative. The stock's performance over the last year, down more than 50%. Even the average analyst rating is basically hold, which is Wall Street code for don't touch this thing, but we don't want to get yelled at. In their world, the price makes absolutely zero sense. But this is where it gets interesting. If you look at the history, you see exactly what you'd expect. Underperform, sell, sell. But then, look at the more recent ratings. You start to see a shift, a couple of upgrades, from sell to neutral. One even goes to outperform. It's almost like some of them are starting to realize that their old spreadsheets might not be telling the whole story here. So you've got these two camps dug in on opposite sides, but for anyone trading day-to-day, it's just pure chaos. It's a fire hose of data, and most of it seems to contradict itself. It's a lot of noise. You get these weird concepts like max pain. Sounds fun, right? It's a theory from the options market. The idea is that the stock price has a strange tendency to drift toward the price where the most options contracts, both bullish and bearish bets, end up expiring completely worthless. It's like a black hole that just wants to cause the most financial pain possible. A strange, powerful force. You can really see this daily tug-of-war when you look at the options for another stock we all know and love, GME. For options expiring way out in late 2025, look at that difference. Over 33,000 bullish bets versus just over 8,000 bearish ones. It's a clear snapshot of the insane optimism on one side of this fight. So you've got the short numbers, the company fundamentals, the options market, what people are screaming about online. It's all pulling in different directions. How on earth are you supposed to find a clear, simple signal in the middle of all that? Yeah, sometimes you don't. Sometimes you're out there scanning the cosmos for a clear signal, and what do you get? A 404 error. And you know what? Some days that feels like the most honest chart you're gonna see. Pure, beautiful chaos. Okay, let's zoom out. Let's try and make some sense of these two completely opposite stories. Because what we're really talking about here isn't just two different ways to invest, it's two different realities. You've got the Ape Thesis. It's all about the mechanics of the market, short interest, squeeze potential, and the raw power of a community that refuses to back down. Traditional numbers? Irrelevant. Then you have the Wall Street story. It's built on fundamentals, analyst reports, and a century of financial theory that says this stock is just plain wrong. They're not just on different pages, they're reading completely different books. And that leaves us with the one question that really matters. Is what we're seeing just a weird fluke, a bubble that's going to pop and be a funny story we tell our grandkids? Or is this something new, a real change in the way the market works, powered by people and technology? Is this the future, or are we just living through a wild glitch in the simulation? The only thing that's for sure is that the market is always changing. The rules are always being rewritten. So my only advice is this: stay curious, do your own homework, and find the platforms and tools that feel right for you. If you're looking for a place to start, you can check out the description for the latest promos from Public, Webull, and Moomoo. Until next time, stay safe out there